Hey everybody, Tom Murray, call sign Brother. I'm a retired naval aviator and now I run Clear to Climb Realty. I'm a full service real estate company based in Coronado, California, providing home buying and home selling services as well as property management across San Diego County. In addition to that work, I love to do financial education for all things, especially real estate, because I think a lot of these concepts are misunderstood. I'm here today to talk to you about some of the tax benefits associated with home ownership. If you're a homeowner, and you have been for more than one tax year, you're probably aware of the fact that you can deduct mortgage interest and property taxes. But for many of the people shopping for homes or considering buying, you're probably ignoring the tax benefits that will absolutely impact you in a good way. So of course we all understand the idea that instead of renting, I can buy a property, own it, and instead of paying somebody else's mortgage, slowly pay down the balance I owe on my appreciating asset. Well, that's of course a great fundamental understanding of real estate and the financial benefits. Let's look at the tax benefits though. First, let's get a little background information out there. 87% of taxpayers in the United States use the standard deduction. The standard deduction in tax year 2025 is $15,000 if you file singly or $30,000 if you file as married jointly. And what does that deduction actually mean though? Deductions lower your taxable income, which has the secondary effect of lowering the tax you owe by your tax rate. So let's do a real simple example. Let's start at the top with gross income. So if you have gross income of, let's say, $100,000, in order to actually calculate the tax you owe, we have to back into your adjusted gross income. Not all income is taxed. The military housing allowance is a great example. So let's say you have some part of your income not taxed, and then your taxable income, let's say, is $68,000 after we remove that portion of your income that's not taxed. Now, the next step we're going to do is apply your deductions to get your adjusted gross income, or AGI. For our standard renter out there who doesn't have a ton of deductions, you're going to get to leverage the standard deduction. So we'll take our $68,000, subtract our $15,000 in standard deduction, and you're going to wind up having an adjusted gross income of about $53,000. The government will then calculate the tax you owe by applying the tax rate to your adjusted gross income. For somebody with an AGI of $53,000 that is single, you're going to owe tax of about $550 a month, which comes out to an annual tax bill of about $6,600. So $550 per month is your federal tax, which is about $6,600 for the year. Okay? Now let's take somebody who earns the same exact amount of money but has decided to purchase real estate. This person, to get this person's new AGI so this up here we've got them renting. If they're a buyer, if they just purchased property, and let's say they purchased a $650,000 condo here in San Diego, which is a couple $100,000 below the median home price. Based on today's interest rates, they're going to wind up having mortgage interest payments in the first year of over $40,000. It's actually over $42,000. And then they're going to have property taxes as well, both of which are deductible. Here's where this gets fun. So instead of the $15,000 standard deduction, our homeowner is going to get to deduct $42K in mortgage interest, because you can deduct mortgage interest on the first $750,000 in mortgage debt. And then they're also going to get to deduct about $8,000 in property taxes. Today, I'm recording this on January 20th, 2025. Today, the IRS limits us to being able to deduct the first $10,000 in state and local taxes, or SALT. There's talk that may change in the future. However, today we're limited to 10. This person who bought a $650,000 condo in San Diego is going to have about an $8,000 property bill. So in their first full year of home ownership, they're going to have $50,000 in deductions just from their mortgage interest and property taxes. But wait, now that they are itemizing their deductions, not using the standard deduction anymore, they're itemizing their deductions using Schedule A. They also now get to claim any other things that would have been deductible but that they previously couldn't use. For instance, medical expenses, gambling losses if you've got those. I hope you don't. Charitable contributions. So let's say this person has none of those. They still get $50,000, which is over 3 times better than 15. So now we take their taxable income of $68K, we subtract their $50,000 in deductions, and they have an adjusted gross income of $18,000, putting them in the 12% tax bracket instead of the 22% tax bracket. This person is now going to owe about $150 per month in taxes, which is an $1,800 tax bill for the year, substantially lower than the renter's number up here. So there's a $5,000, almost a $5,000 swing in this person's take-home pay because their tax bill is lowered by $5,000. As your income changes, as your deductions change, all of these numbers change. So this example, these numbers really only apply to one specific example. However, the general concept that increasing your deductions lowers the tax you owe is a universal truth. The more deductions you can accumulate above that standard deduction allows you to lower your adjusted gross income, which then lowers the amount of tax that you owe to the government. There's a lot more tax strategy associated with owning and investing in real estate. This is just the tip of the iceberg, but some great information that is often misunderstood. If you've got questions about this or anything else you'd like to learn about, reach out. I love talking about this stuff, and I can't wait to hear from you. Talk to you soon.